you have to realize we're at a point in the economy where you cut rates because there's tension. And there's tension between employment and unemployment. There's tension between earnings, growth, and contraction. And so it's a stimulatory move. So if you look through that stimulatory move, why is the Fed doing this? And why will they cut probably all the way down to 2 or 3% by the end of 26? It's because we now need to stimulate the economy. So the reason why markets tend to fall once the rate cut cycle starts is because the next couple of quarters sort of demonstrate what I think the Fed is expecting, which is that there's pressure in the economy.
Chamath Palihapitiya is a prominent venture capitalist, entrepreneur, and former Facebook executive known for his outspoken views on technology, finance, and social issues. As the founder of Social Capital and a frequent commentator on economic matters, Chamath's opinions carry significant weight in both Silicon Valley and Wall Street circles. His insights are valued for their blend of tech industry knowledge and macroeconomic understanding. In this episode of the All In podcast, Chamath shares his thoughts on the Federal Reserve's recent 50 basis point interest rate cut and its implications for the global financial markets. He expresses concern that this aggressive rate cut may signal underlying economic pressures not yet fully visible in public data. Chamath suggests that the Fed's actions could indicate expectations of downward GDP revisions and potential economic contraction. He emphasizes that markets often fall after rate cut cycles begin, as they tend to precede periods of economic pressure. Chamath warns viewers to pay close attention to how companies describe their market conditions in the coming quarters, as this will reveal whether there is real pressure in the economy or if it's just business as usual. And make sure to watch the full video in order to gain a comprehensive understanding of Chamath's analysis, as he delves into topics such as the impact of AI on call centers, government spending on rural broadband and EV charging stations, and reflections on recent challenges in the venture capital industry.
You have to realize we're at a point in the economy where you cut rates because there's tension. And there's tension between employment and unemployment. There's tension between earnings, growth, and contraction. And so it's a stimulatory move. So if you look through that stimulatory move, why is the Fed doing this? And why will they cut probably all the way down to 2 or 3% by the end of 26? It's because we now need to stimulate the economy again. So the reason why markets tend to fall once the rate cut cycle starts is because the next couple of quarters sort of demonstrate what I think the Fed is expecting, which is that there's pressure in the economy. We have not seen that flow through in earnings or in how companies describe markets on the field, by and large, except for a few. So I think this part of the cycle now will be about all of these companies telling us whether there's nothing to see here or whether there is actual real pressure. And if there is real pressure, it'll probably look like the several times before, where you're just going to have to contract the value of financial assets because they're just not worth as much when they're earning less.
Okay. Sachs, any thoughts here? Just balls and strikes?
Well, I think a lot of people are commenting on the fact that the only other 2 times where we've had a 50 basis point rate cut in modern history, it has been just before a recession. So I think this happened in 2001, 2007, right before the recession. And the Fed had to do a dramatic rate cut because they could see in the data that things were weakening. So a lot of people are asking the question, well, is that what's going on here? Now, Powell's comments, though, are indicating that the economy is in good shape. He said the economy is in very good shape, that basically indicating that they had tamed inflation and that they would look to cut another 50 basis points this year. So Powell's rhetoric is, in a way, at odds with the magnitude of this cut. So why didn't they just cut 25 basis points? I think people are trying to figure that out.
Reading the tea leaves into why 50, because they could just do 25 a month.
Sure,
for 5 months as opposed to 50.
If the economy's hot, why wouldn't you tiptoe into rate cuts and just do 25 now?
That's the key thing. If you look at the the dot plot, and if you look at where the smart financial actors are betting where rates end, so it's hard to sort of like look at any point in time, 50 now, 25 later. What does it all mean? It's very hard to know. But what is much clearer is where do we think terminal rates will be even in the next 18 months? And it is dramatically lower from where they are now. And I think that supports, Sachs, that argument that you just made, which is if you're going to basically cut this aggressively over the next year to year and a half, by the estimates of very smart financial actors whose job it is to spend every day observing the Fed, then they must see something. Because otherwise, as you said, you could take a much more gradual approach. And so I think that the smart financial actors are guessing recession or guessing contraction. I think what they're also guessing is similar to non-farm payrolls. We're going to go through a couple of difficult GDP revisions, probably downward. And I think that will have an impact to people's sense of how the economy is doing, even more than what their sense is today, which is already teetering on it's at best okay. And I think all of that has to play itself out. So it's going to be a very complicated and dynamic fall in that respect. I'll preview one use case from 8090, which is pretty stunning. You know, we work with a very large, regulated, highly regulated company, public company. And they have a very complicated set of people and processes because of the field in which they're in. And David, your point is exactly right. It took us a fairly long time, but we're at a point now where we've been running AI-powered software versus the old legacy deterministic solution. And we've been running it at 100% accuracy now for about 10 days. So this is still very new. And it's an incredible thing because, to your point, our first version was like in the mid 80s, then we were in the mid 90s, then we were 97, 98%, but there were still errors. And it just took a lot of engineering to figure out how to get to 100, but now it's at 100 and it's been consistently at 100. And so we're all kind of like scratching our head because now the next step is, well, what do we do? To your point, what do we do? So we're figuring that out right now. But the art of the possible is that I think well-crafted AI software is as good as deterministic software in the sense that the error rates will be equivalent in production and at the level of a very highly regulated public company. And I think that's the gold standard because in those sectors, those companies have zero tolerance. It's not a toy. It's not even, level 1 customer support. It's system of record type work.
Yeah.
But it shows what's possible. And to your point, Sachs, we're doing that today, even though they're the best models. Imagine how good the underlying models will get in a year from now. Is that I think it's starting to add reasoning. But the way that you do reasoning is sort of this idea that you have this chain of thought. And I think that that's a very powerful but early concept. And as we refine those ways in which these models get to better answers, the wonderful thing is that OpenAI will preview O1, and then they'll have the actual O1 production build probably in the next couple of months, which will be probably pretty spectacular. But then you'll see something from Claude, you'll see something from Llama, and the real art, I think, and this is where I do think it's a little bit of alchemy still, which I think is good because it keeps humans involved, all of us involved.
Yes.
Right? Is how do you stitch all of those things together to get to a 0% error rate? What Sachs said, how do you minimize the blast radius and how do you make sure these things are super high quality?
In conclusion, Chamath expresses concern about the Federal Reserve's aggressive 50 basis point rate cut, suggesting it may signal underlying economic pressures not yet visible in public data. He warns that markets often fall after rate cut cycles begin, as they tend to precede periods of economic strain. Chamath advises viewers to closely monitor how companies describe their market conditions in upcoming quarters, as this will reveal whether there is real pressure in the economy or if it's business as usual. And that's all for today. If you enjoyed this video, please give it a like, subscribe to our channel, and hit the notification bell so you don't miss any future updates. Thanks for watching, and stay tuned for more.